Hey everybody, Marty Missouri. Good morning, October 6, 2016. Today I thought I'd just do a quick take little video for you. And then tomorrow, give you the weekly message. I think tomorrow's message is going to be somewhat softer, much easier to read than the last one or two. Um, Tomorrow's jobs number, I think, has the market a little upset this morning. Dow's down about 100 points. Remember that first hour tends to be when retail investors, when individual investors come in and react on their emotions. And then things tend to settle down until about the last hour of the day. So we'll see, barring any news in between. The dips lately have been getting bought. Makes sense to me. There's been a decidedly bearish tone to the market, which means more people have been living on the side of the fear of losing as opposed to fear of losing out. And we've kind of talked about that, and I've illustrated that concept for you, that people are fickle, and when they move from one extreme to the other, they take action. And going from the fear of losing to the fear of losing out means you buy. Again, the jobs number tomorrow, the supporting indicators that I track actually tell me that we should expect a good jobs number, better than expected. I am not making that prediction. I've been surprised before, but again, the preponderance on balance of supporting data indicators, if you will, tell me that it's probably going to be a pretty decent jobs number. And that probably explains a bit of a sell-off this morning. The market still seems to be, on a short-term basis, focused on the Fed, despite the fact that we have the election coming up, we have earnings coming up, and so on. So I think there's going to be some adjustment as it looks more likely that the Fed will raise interest rates in December. So in front of you, let's just really quickly rush through the sectors. I'll make a quick comment on each, talk about what I think is inspiring it. The first one there is technology. These are the index ETFs that we use for each sector. And this is just a 1 month look. And as you can see, technology has been doing pretty good. Technology actually would not fare poorly necessarily, historically speaking, on a Fed rate increase by itself, given its own dynamics. I've been talking to clients in meetings lately about the prospects for a pickup in fiscal spending on the government side next year. We're also seeing some real signs of late that businesses may be finally in the mood to spend a little money. These are things that could positively impact technology. Next one is industrials. Definitely on the infrastructure side. I do think the political pressure to get busy on infrastructure, and not only in the US, is going to be something that we see materialize next year. That would be good for industrial stocks, and that may have something to do with this very nice increase we've seen of late. The next one would be consumer discretionary. It hasn't had a great year, but been coming back a little bit with better economic indicators of late. Materials have been kind of all over the place. Actually, have had a pretty decent year, but you can see in the last month as the dollar has gained a little steam once again, or at least threatens to. Materials, while I can make a case that in a world where we're going to see more building, particularly on infrastructure, that would be bullish for materials. If indeed we see some inflation risk, which I think we're about to see, that would be good for materials as well. The offset there to some degree would be a higher dollar. We've had OPEC agreeing on some freezing of production, maybe even some cuts. So that's been a boost to energy prices. We'll see. We've also had like a 5 week in a row inventory draw from energy. So we'll see if that continues. I do expect production to pick up in the US, of course. Here we have global natural resources. So again, that look that is largely influenced by energy as a component of that, with some choppiness relative to other materials in the dollar and so forth. But that's a pretty good look for the last month for global natural resources. Financials, nice boost, as the fear of higher interest rates would lead to net interest margin increases for banks. So that makes sense to me. That very well may continue. As I've said to clients in meetings, banks look really cheap. Financials in general do, ex-real estate, that is. Healthcare, been having a rough go of it. We've got the election. Should Ms. Clinton win, that would be viewed probably as a negative for healthcare with all that rhetoric. But although the other side is also kind of engaged in pricing controls on pharmaceuticals and so forth, had a pretty good run up to this year for healthcare. Valuations got a little stretched, although they're getting a little more reasonable here. But we are seeing defensive stocks kind of get taken out a bit. When we want to get to the, well, still with defensive stocks, this would be staples. And I'm going to say staples are a little more interest rate sensitive these days because a lot of people have been buying those for yields. So a higher rate market in a sector that really looks a little bit extended or rich from a valuation standpoint would be a negative. And then lastly, utilities, exceedingly interest rate sensitive. They're going to move very much like bonds. We have a zero target to utilities these days. They're getting cheaper. Valuation wise, don't look as scary as they did, but I do think there's a big exodus probably continuing in utilities if indeed the threat of higher interest rates remain. So, folks, look for the jobs number tomorrow. It could really move the market one direction or the other. Whether or not it's worth commenting on tomorrow from me, you'll find out if you get something in your email from me. But you will get something tomorrow or Saturday, just kind of as a weekly message. And I'm going to make this one a little more entertaining than the last. And I'll leave it there. Hope you have a great day, and I'll talk to you very soon. Bye bye.